Watching your money make money, well, that's a lot of fun, and that's a good thing. But what if the cost of everything around you is going up at the same time? Then have you really done that well? It's called the real rate of return, and we are going to throw the curtain back on that today on, of course, the current temp. Thank you, everybody, for joining us. I am Joey Solopek, joined alongside longtime partner and co-host and mentor and co-owner of equity management company, Bill Gerner. Bill, thank you for being here. As always, the first and biggest shout out to Lexus of Memphis, without whom we would not be doing this. We love that group of men and women. You know how we feel about the product. We got lots of owners in this group who love the product and the people. You can't go wrong. Go by and say hello. And of course, EMC Equity Management Company, where Bill and I both work. We're both owners and have a great team around us. You can ask any question you want by going to emctn.com. All right, Bill. This was an interesting one, and you had this idea that we were going to discuss the real rate of return. How would you describe real rate of return?
Well, first, I think it's a term that people aren't used to. They hear it, but they don't really know what it means, and I just thought we'd try to clarify that today. And
Okay.
The real rate of return is the return you get on your investment. Like a CD, you get 4.25%. And then inflation is 4%, then you really only made 0.25. You're just keeping up with inflation. You're really not making enough money.
Okay, here's another way of saying it. It's your account balance rising. Okay, let's say you're making money, but your standard of living is losing ground. And so when we're looking at the real rate of return, like Bill just said, one of the first things we have to think about is inflation. All right, so what is inflation? Inflation is the general rise in prices of products that we need over time. And what that does is, and I've heard you say this a million times, it reduces your purchasing power.
It does. It's very important. Like if you work for a company and you only get a 3% raise and inflation's 3.5, you actually didn't get a raise.
Right. You're behind the eight ball.
That's right. You're already behind it.
And something to keep in mind, you know, inflation changes a little bit every year, but I would say we've been around 3 to 4%, haven't we, here recently? I mean, they're trying to bring it down, and it does fluctuate a little bit, but that's going to be an important component as we talk about this, because we're going to talk about earning more than inflation. So what does real rate of return mean? It means, what is your money really worth? All right, we're going to start with example number one. Bill, I've got example one here behind us, where if you have stock as an investment and you make 10% on it, okay?
Okay.
But inflation for that year is at 3.5%. To your point, you really only made 6.5%.
Right, but that is a real positive real rate of return.
Right, so if you're trying to figure out what did you make, your real rate of return would be 6.5%, but you have to take inflation into account. Now, where this gets interesting is example number two, where we're showing a CD. Now, many of you have heard of CDs, certificates of deposit. Banks like to issue these, and they lock your money up, but they promise you a rate of return. But you got to keep in mind, per what we've been talking about, I think 4.25% is a pretty common CD rate of return. But if inflation for that year was at 3.5%, your real rate of return was only 0.75%, and I would say that's really low.
It is. And I think the easy way to remember the real rate of inflation is you see the rate of return, and all you're doing is subtracting the inflation rate, and that's how you get to 0.75.
Well, I think what's important here is to really drive home to folks, inflation doesn't get talked about enough. And we tell clients all the time, if you're sitting your money just in a savings account or checking account, it's going down by 4% every year because of inflation.
Right.
And a lot of people do that. They think I've got some money, maybe you got an inheritance or a windfall or whatever, and they'll have a big chunk in the savings account where it's got nothing, really no rate of return. But as long as it sits there, it goes down by 4% every year because inflation goes up.
Yeah, and the inflation rate that you have there, Joey, the 3.5, is what we call the CPI. That's the Consumer Price Index. And that is the cost of goods and services. But they also have another inflation rate, which is called the core inflation rate. And what that is, you take food and energy away from that 3.5, and the rate today is 2.6. So, but food and energy are very important to the consumers because everything's geared around it.
All right, let's talk about the real world impact of inflation, okay? How much were Cokes when you were a kid?
You know, I want to say 12 cents if I'm going to say a dime.
Okay. What about a phone call? How much was a phone call?
10 cents.
10 cents at a pay. What about a movie?
Oh, it's a quarter.
That's inflation. I want you to consider what's a movie now, I think costs $20. Your money does not buy as much now as it did, and that's going to continue going forward. So as we go into next year and the next year, if your money is not doing more than around 3 to 4% for inflation, you're going backwards.
I think the important thing on the chart that you did, and it's really a nice looking chart, is that if people each year do not earn more than the inflation rate, then they're losing money.
I've heard you say that a million times.
Because if the CD rate was 3% instead of 4.25, you'd be losing 0.5%.
Right.
And we've seen it that way in the past.
Yeah. Okay. Now, this is part one, what we're talking about today, of a 3-part series. We're going to have 2 more episodes over the next 2 weeks to follow, and I'm going to set up a future one with this, okay? Historically, stocks have outpaced inflation when they're held for an extended period of time, okay? Now, this is generally measured in years or decades, not months or short periods of time. And so I want to make sure I'm being clear that over time, stocks outpace inflation. I don't want to give too much away because we're going to get into what they should do. We got a whole lot of really exciting stuff for you. Any final thoughts about rate of return?
The rate of return is important, and investors need to be sure that each year that their increase in income at least is something above the inflation rate.
All right. Take that home with you. And remember, per Bill Gerner and your whole team here at the Current Temp, in your investments, you've got to be at least outpacing inflation, and hopefully you're doing much better than that. And remember, when investing, I got to say this all the time, past performance is no guarantee of future results. So we're talking about historical averages and ideas going forward. Just know in the investment world, there are no guarantees, but you can make smart decisions. All right, here's the teaser for next week. I thought you would like this. Next week, here's what we're going to ask. What does all this mean for you and your family? The stuff we just talked about, right? If you're trying to figure out, what does that mean for me? Here's another one, and we're going to talk about this next week. This is fascinating. Where exactly is the poverty line in Memphis? I mean, what is the specific number? We're going to give you that. And how much money do you need to earn annually to live comfortably in Memphis? I mean, I think these are things everybody's wanted to know, but we're going to answer those next week. A little bit of a teaser for everybody. And as always, folks, if you've got questions, visit our website, emctn.com. We got deep roots and new branches, and I'll tell you, when trust is a must, you want to talk to us. And you can email us as well, thecurrenttemp@gmail.com. Let me tell you this, finance matters.
It does matter. You're the best.
Hey, friends, we will see you next week.